Hi everybody, this is Alan Ellman, the Blue Collar Investor. In Lesson 5 of the Beginner's Corner Information Series, we're going to take a look at calculations for stock and option selection as it relates to our covered call writing positions. Now before I get started, I want you to know that all these calculations will be done for you with the basic Ellman Calculator. And at the end of this video, I'm going to show you how you can get a free copy of this calculator. So sit back and relax, because I feel that we'll all become better investors if we have at least an understanding as to how these calculations work. Now, the three basic formulas we're going to look at today start with the return, the initial return on the option for at-the-money and out-of-the-money strikes. An example would be for an at-the-money, you buy a stock for $30 and you agree to sell it for $30. For an out-of-the-money strike, you buy a stock for $28 and you agree to sell it for $30. That was our preview example. The second formula relates to in-the-money strikes. You buy a stock for $32 and agree to sell it for $30. That has a slightly different formula than the first one. And the third formula is our break-even, which relates to our total covered call position. And as you'll see, that's the same for all the different strikes. So let's start with the at-the-money and out-of-the-money strikes. Our option premium is all time value, or all profit. If you remember to our option basics lesson, the option premium consists of time value and intrinsic value. Intrinsic value relates only to in-the-money strikes. So for the at-the-money and out-of-the-money strikes, there is no intrinsic value. It's all time value. So the formula is as follows. You take the option premium and multiply it by 100 because there's 100 shares per option contract. You divide that by the price per share times 100, our cost basis. So in our preview example, if we bought a stock for $28 and sold the $30 call for $1, the formula would be as follows. $1 times 100, our option profit, divided by $28 per share times 100, our cost basis. And that comes out to a 3.6% 1-month return. Now, out-of-the-money strike prices, like this one, also will offer you upside potential. In other words, you can make additional profit if the price of the stock moves from 28 to 30 or higher. You can make up to an additional $2 per share. At-the-money strikes, the 30 and 30, offers you no upside potential and no downside protection of the option profit, but it does give you the highest initial return, as you'll see in a later slide. Now, the formula for calculating in-the-money strikes is slightly different because it does have some intrinsic value. Now, our option profit, if you recall, is the option premium minus any intrinsic value. So if you buy a stock for $32 and sell the $30 call for a $3 premium, we can't consider that entire $3 premium profit because we bought a stock for $32 and agreed to sell it for $30. We're going to lose that $2 intrinsic value. We must deduct that from the $3 premium. So the time value of that $3 premium is $1, our profit. So what happens to the other $2? We're not counting it as profit, but yet we received it. What happens to it? Well, what we do is, for calculation purposes, we will reduce our cost basis of the stock. Instead of saying we bought the stock for $32, we're going to reduce that with the other $2 down to $30. So for calculating our returns, we say our cost basis is $30. So the percent profit that we make in the example that we just gave is $1 times 100, or the time value, divided by 32 minus the $2 intrinsic value, giving us a cost basis of $30 per share, or $3,000 for the 100 shares. And that turns out to be an initial return of 3.3% for the 1 month. Now, in-the-money strikes do offer downside protection of the option profit because the stock is currently at 32, and that 3.3% is guaranteed as long as the stock does not drop below 30. So we have $2 of protection of that option profit. And later on, when we show you the calculator, we'll show you how the calculator breaks this down for you. The break-even of the total position is very simple. It's the stock price minus the total option premium. In the in-the-money example we just gave, we bought the stock for $32. We received $3 option premium, and that means our break-even is $29. However, I'm not interested in breaking even. We do covered call writing to generate a monthly cash flow. So I'm more interested in the initial return on the option, any upside potential, or downside protection of the option profit. Now, let's review some of these strike prices that we've been talking about as it relates to these calculations. And we mentioned these before, but let's review them again. The out-of-the-money strike, we buy a stock for 28 and sell the 30 call. That gives us our initial option premium plus upside potential to the strike price. So if we received $1 of time value profit and the stock goes from 28 to 30, now we've made a total of $3 profit. And that relates to the out-of-the-money strike. The at-the-money strike, we buy a stock for 30 and sell the 30 call, gives us our highest initial option profit, but gives us no upside potential and no downside protection of that initial profit. The in-the-money strike gives us our initial option return plus downside protection of that return. As we said before, the stock was sitting at 32, we sold the 30 call, and our profit is protected as long as that stock price does not drop below 30. So let's start looking at how we do these calculations and how we get the information to feed into the Ellman calculator. And what we have to do first is locate an options chain. In this case, we're showing you the chain for HITK, and if you look at the bottom of the screen, you see 3 arrows, a red, a blue, and a green. On the upper left part of the screen, you see that the price of the stock is $22.34. So let's take a look at some of the strike prices available to us. On the right-hand column towards the bottom, you see that I've highlighted in yellow 3 strike prices. The $20 strike is in the money as it relates to the $22.34 current market price. The $22.50 is just about an at-the-money strike price. We call it near the money. And the $25 strike price is out of the money. The arrows show you the option premium we'd receive for each of these strike prices, $3.10, $1.70, and 80 cents. So we take this and we go to the single tab of the Ellman calculator and enter the information into the blue cells. And you can see here the 3 strike prices, 20, 22.50, and 25, and the price that we receive for the option premium, $3.10, $1.70, and 80 cents. Once we've entered that, on the right-hand side in the white cells, we get our calculations. Now there's a lot of information here, so let me just point you to the most important, and you could study the rest later on. The third row of circled percentiles from the bottom shows your initial option return. So the first column is the $20 in the money strike, and you can see that generates a 3.8% initial profit. Once again, that's just time value. The calculator will deduct the intrinsic value for you. The middle column is for the $22.50 near the money strike, and that generates a 7.6% 1-month return. As we said before, these at the money or near the money strike prices will generate the highest initial returns. And the column on the right shows the out of the money $25 strike generating a 3.6% 1-month return. Now, the in the money strike, if you look at the middle of the page, the red circle there gives you downside protection of 10.5%. So what that means is the 3.8% initial option return is protected as long as the price of the stock does not depreciate by more than 10.5% during that 1 month. The middle column is the 7.6%, and you can see you get no downside protection there. There is a slight amount of upside potential, negligible though. And finally, the column on the far right is the out-of-the-money $25 strike, which gives you a 3.6% initial return. And if the price of that stock goes up to and past the 25 strike, you can actually generate another 11.9% for a possible total of 15.5% 1 month return. Now, using at-the-money and out-of-the-money strikes is a bullish position. If you want to be more cautious, you'll opt for the in-the-money strike, which as you can see isn't so bad. In this case, 3.8% in 1 month with 10.5% of protection. Now I also want to show you the multiple tab of the Ellman calculator. If you want to evaluate multiple stocks with multiple strike prices, you enter that information into the blue cells, and on the right hand side you'll see 3 columns that give the information that we need to make the best decisions. The first column, the return on the option, the root column, gives you your initial option return. Now remember, for in-the-money strikes, the intrinsic value is deducted for you. This is the actual profit. The middle column is the upside potential, which relates to the out-of-the-money strikes. And if you feel the market is bullish and you're feeling good about the market, you're going to want to opt for stocks that have the greatest upside potential. And the column all the way to the right is the downside protection of the option premium. And again, if you're in a bearish market, or if it's a volatile market, or if you're just a very conservative investor and you want that extra protection, then you'll look for the columns that show the greatest amount of downside protection, once again, of the option premium. Now, as I promised you, here's how you can get a free copy of the basic Ellman calculator. Just simply email me at alan@thebluecollarinvestor.com, put in the header Basic Ellman Calculator, and include your name, and I'll be happy to send it to you. So to summarize, because in-the-money strikes have intrinsic value, the calculation formula is a little different than that for at-the-money and out-of-the-money strikes. Break-even relates to your total covered call position. Downside protection relates to preservation of the time value of the option premium. It protects our profit, and that relates to in-the-money strikes. Each strike price category has its pros and cons, and you should know them when making your covered call decisions. In Lesson 6, we're going to discuss executing covered call trades. Take care, everybody.